Welcome back to the Real Estate Standard Podcast, episode 8, where commercial real estate and Bitcoin collide. I'm your host, Tim Kotzman. Today's February 9th, 2026. Each episode breaks down how serious operators, investors, and developers stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin, the lens of evolving capital markets, and long-term strategy. On today's episode, we're diving into syndication with Boomer Beatty. But first, I'm going to hand it over to Kenny for an update on West Main storage stacking.
Hey, Tim. Thanks. Today's February 9th, and our Bitcoin holdings are currently at 2.75 with our stack from last week. We are up to just over a half a Bitcoin for the year. 56 million Satoshis in 2026, bringing our Bitcoin yield to 25%. Our Bitcoin per square foot is just under 4,000 Satoshis per square foot at 3,966. And we're currently holding enough Bitcoin to cover our mortgage for 8.5 months, 8.5 months. I'll just reiterate, last week we had a big announcement. West Main Self Storage acquired 2,014 shares of Stretch. This is going to increase our net operating income by 3%. And over to you, Chris.
Yeah, awesome, Kenny. Another week of stacking the dip. I love it. The commercial real estate markets don't move nearly as fast as Bitcoin or other global markets by any stretch. So it'll be really exciting to see, how these metrics improve over the coming, quarters as we crawl out of this, this price discounted zone here. So, but with all of that, I'm really excited for our conversation today. Boomer Beatty is a commercial real estate expert. He's got some brokerage experience. He's got some investment experience, particularly on the syndication side. And I'm just really excited to kind of dive into the details on, what are things looking like from your vantage point, Boomer? Whether it's just a traditional real estate standpoint, and then, through the lens of Bitcoin. What are those conversations like with some of your partners, your investors? How do you guys kind of think about integrating Bitcoin strategies into the portfolio? I think there's a lot of different questions out there, and a lot of the marketplace are they're searching for these answers, and I think a lot of people just don't speak up about it because they don't want to seem uneducated or uninformed on the topic. So I like to think that we're kind of pioneering this whole discussion here. So with that, I'll let you, maybe give us a little background and we can go into it from there.
Great. Appreciate it, Chris. So, been in real estate, basically my whole life, grew up in a real estate family, but graduated Boulder, got into brokerage right out in kind of 2014 before market kind of, started to, do really well here in Colorado. And really, for 10 years focused on, kind of brokerage, and then on the side, started investing with partners, buying some real estate deals, getting in the trenches, from capital raising to operations. And along that way, got into Bitcoin in 2017. Actually got introduced to it by our capital markets team out here in Denver. So, started to do a little bit of research, started to buy, obviously, kind of fell down the rabbit hole pretty quickly. So started to kind of build the, internal, my portfolio in Bitcoin, and then obviously in real estate, and kind of brings me to where we're at, today. And as far as, kind of what we've been focusing as of late on, I think with, just conversations that we've had is, how do we bring, how do we integrate Bitcoin into real estate? I think, when I saw your videos, that you had put out maybe 6 months ago. Obviously wanted to get involved because I was kind of thinking along the same wavelength as you. And real estate is such an old school, old boys kind of club. And it's, as you mentioned, it's slow. Whereas like you then look at Bitcoin, and Bitcoin's like in hyperdrive, right? I mean, it's changing so quickly. Adoption is happening so fast. The market around it is changing, obviously even faster. So, I looked at it and I said, well, what can we do, within kind of our portfolio, maybe on the personal side first, before we went into maybe a lot of our legacy partners and pitched the idea. And so, we were basically exploring. Our first thing was a refinance, and we were going to basically do a cash out refi and buy Bitcoin, put on the balance sheet. That was towards the end of last year where we really kind of honed in on that. Ultimately, we didn't move forward with the refi. It's actually going to be happening hopefully at the end of this year. A lot of that maybe was attributed more towards market dynamics on the real estate side. So we wanted to be a little bit maybe more defensive in that strategy. But it's still on the forefront. It's still kind of our number one goal for this year. And then I also put together a slide deck basically for our majority partners in some of the larger mobile home parks that we are involved in, that we manage, that we operate. And these are kind of the core guys. And so I put together a slide deck and went and pitched it, in December. It was received really well. A lot of it was education. And then really, I tried to kind of bring it home on why I think it's important for them to integrate this kind of in three separate ways with the real estate. And so we can kind of dive into, talk about those three different, strategies. But I don't know if you have any questions so far.
No, absolutely. That's perfect. Perfect background. And just for the audience, what kind of brokerage are you focused on, and what are the investment holdings? What product property type?
So multifamily on the brokerage side, core Denver market. Like I said, private clients, so anything under $20 million.
Got it. Okay. I just asked because it's nice to as Kenny and I and Tim have just explored this intersection and batted back and forth different ideas and different approaches. It's one of the things that has become very apparent is that the options, that the feasibility of all these options depends greatly on the product type that you're operating in, right? What works in apartments doesn't necessarily work or even is applicable in, industrial or office, what have you. So I think just, kind of setting the stage from that standpoint is helpful. And I mean, I want to hear more about, how you framed this, this education, presentation with your partners. I mean, I know Kenny and I have some ideas on how we framed it with, with our partners and, some of the audience here, but why don't you tell us a little bit about that?
Yeah, for sure. These are, again, a lot of these guys are later in age. They've been in the real estate game for, I would say on average, probably 30 years. So this asset class to them is just a brand new thing, right? So most of them have heard of it, maybe their kids have been involved at some level, but there still was a lot of skepticism. So, what I try to do is I try to condense the first 15 to 20 slides into, obviously what is Bitcoin, or what is money, right? Starting from what is money, and then kind of walking them through, some of the basic principles, of Bitcoin, the protocol, the network itself, network effects and kind of some of that, along with, hash rate, Bitcoin security. I think that was a big kicker for them. And then finally, We do have some partners that are a little bit more skeptical from, call it, the energy standpoint that Bitcoin uses. And so I threw a couple slides in there and labeled it misconceptions, energy misconceptions, and broke down kind of different industries, right? Like the airline industry, how much they use, right? The gold mining industry, the internet. And so, walking them through those things, obviously lots of questions came up in kind of that initial, I would say 10 to 15 slides. And then really, I kind of, like I said, towards the back half of the proposal or presentation, tried to really hit home, hey, here's the three-prong approach where I think we can actually integrate this into the portfolio, and every single different property, we can use different strategies, right? I mean, if there's, 30 plus properties, we don't all need to have, every property doesn't necessarily have the same needs, right? Or the same investors. And so you have investors that might be a little bit more, defensive, right? Rather than investors that want to actually, invest in spot Bitcoin. And so maybe we look at different products like Stretch, and offering that to them and saying, here, this is what I think is good for this partnership. Let's go try to sell it to this partnership, right? There's obviously overlap in the investment group, but we can kind of tailor this approach as needed is really how I looked at it.
Are you saying that the real estate guys are not worried about quantum FUD just yet? They're worried about energy consumption still?
They don't even the quantum stuff is not even in their vocabulary.
Yeah, they can't even spell it. That's probably a good thing for everybody involved. Sorry, Kenny, what were you going to say there?
I was just going to mention, we on one of our previous episodes, it might have been last week or the week before, but we were talking about what comes first. Is it Bitcoin or something like digital rents for these different commercial real estate operators? And I think what Boomer's saying, correct me if I'm wrong, what you're saying is it's Stretch may be an easier thing to educate your LPs on, your limited partner. I don't know how you have it set up, but I'm assuming your LPs.
Yeah.
And they understand cash flow because they're in the business of real estate. So they can wrap their head around that. But when it comes to Bitcoin, there's a lot of prerequisites that they have to learn about. As you mentioned, they have to learn about energy and they have to learn about software, things that they haven't really been involved with, but they understand cash flow. So I just wanted to chime in and say that.
That's exactly right. I mean, I think that was, some of the questions surrounding, okay, well, what good does it do if it's just, not producing any cash flow, right? That's their first go-to. And that's, I would say, the number one question that I get from them is like, why would we hold this if it doesn't produce any more cash flow? And so I do think a product like Stretch would be, super beneficial to a lot of the real estate guys. And there's, I honestly, I feel like that's where a majority of the opportunity in our space is that is on the education side, right? And finding something that is easy for them to kind of understand and easy to implement, right? And maybe holding spot Bitcoin again is just too scary for them, right? Even if you are working with, let's say like a River or, these other exchanges. So I think that where some of these guys, where it does resonate is back to, yes, the cash flow thing for sure.
I think in my journey, I've just found that rather than starting with Bitcoin, it's almost a more productive conversation if you start with the problems that they're facing as a real estate investor, right? The increasing expenses, rent's not keeping pace with it, challenges with getting their refinances done, and you start there and frame all of the frame all of the issues through the lens of TradFi, the Keynesian world that they're all, have grown up in. And then you almost backdoor it with Bitcoin from there. It's like, well, hey, here's all your issues as a real estate operator. What if I told you there was this thing, this new tool and this new innovation that, complements and enhances the real estate, not only from a financial performance standpoint, but an operational standpoint as well. And that has worked for me much, much, much better because you're really meeting them where they're at, and they feel like they can participate in the conversation right out of the gates rather than going through the history of money and network effects and all the stuff that we love to geek out on, right? It can be intimidating. So um, yeah, you got to meet them where they're at and solve the problems that are right in front of them.
I agree. I think, you know, I think Bitcoin is so versatile that it can be used obviously in numerous different ways, maybe almost too many ways, right? I think we talked a little bit about that as well. And it's like, but I think that, getting them off of zero and getting it, into, the partnership or into the portfolio properties, you can start to then, that will just ultimately develop, right? Just maybe naturally or organically. It moves from holding stretch to, okay, now let's maybe, look at holding spot Bitcoin. Or, like I told you, maybe we, have all of the managers at all of the properties, uh, go over to the, Coinbase or Gemini credit card and have Bitcoin, drip into, the balance sheet, that way. So you can do multiple. The way that I did it is, or that I pitched it, there were three different ways. There was like an offensive strategy, the defensive strategy, and then the more neutral strategy. And you can use all three of those or two of those, but again, it's more about focusing on, okay, how do we get this? How do we start to, accumulate more of this regularly, and get the investors comfortable with it?
Yeah, I have a question for you, Boomer. I'm wondering because you mentioned that you originally were going to start out with this refinance
Yep.
and purchase Bitcoin, and I'm not sure when last year that was, but we've been in a downward market. Have any of the LPs checked in on the price and expressed any concern? And have you had to, kind of explain the volatility in Bitcoin?
Uh, two. The two that I didn't think were going to reach out to me did. The other two that are kind of the prominent guys didn't reach out to me, but I'm going to be meeting with them yeah, in 2 weeks. So I'm sure that I'll get an earful of, okay, so what's going on? Why is this happening? Is it a good time? But again, overall, the feedback from everybody was pretty solid. There were lots of good questions that happened. They were thinking about it. I got them hooked up with the materials that they wanted, which was the Bitcoin Standard, uh, Cambridge Digital Assets Report. I don't know if you guys have read that. Really solid report. But there were a few other documents that I got them as well. So I actually think it might be, good that we, didn't do it. Maybe I can push a little harder now to get them to, move maybe quicker. And we could, get an entry point where it's a little bit, I guess better for us for the short term.
I think it's really interesting that you're approaching this from the refinancing perspective, and you were able to hold off, and it's looking like it might be a better time to take advantage of this now with the interest rates coming down and the Bitcoin price coming down. And it seems like you've also given your limited partners the ability or the time to kind of learn and educate. And the fact that they are watching the price shows that they are interested, and that this wasn't all for nothing, that your deck here, your slide deck, really got them interested, and that they're wanting to learn more. So I just wanted to mention that as well.
Yeah, I would say that I also had a few of their kids reach out, which is, positive as well, and got them stuff. So it's definitely in the conversation, which I think again is just, it's consistency of like, hey, here's what's going on in the market. Maybe we shouldn't necessarily focus on the price, but let's focus on again the network, and the growth and the adoption that's happening here, because nothing really fundamentally has changed besides the price of Bitcoin, right? So yeah, like I said, I'm gonna give another push here in 2 weeks when I meet with them. I'm gonna have a few other things to present. One of them is going to be I took 8 properties and I went ahead and took all of the current distributions that we pay, the current NOI, and then the money that we have just sitting idle in, money market accounts or checking accounts or operating accounts, whatever they might be. And then I overlaid, putting the money market funds and checking funds into Stretch. And ultimately what that, would do is it actually, if I look at it, on average, it increased the distributions by 15%, and increased NOI by 8. So, really solid increases overall. And maybe this hits home with them a little bit more when they can see this in a third of the portfolio, right?
We've talked about this repeatedly. I mean, it's going to take time, it's going to take education, but ultimately what's going to, make this happen and materialize is the numbers on these types of assets are going to speak for themselves, right? I mean, Kenny was able to increase his NOI by what, 3%? Kenny?
Yeah, just with our first purchase. So we took out just a small $200,000 loan, and we're doing like the carry trade. So we're pocketing like 5.25% spread between the current yield of Stretch and what we financed the loan for. And so this is kind of like proving our concept as well. Like this is a 3% increase on borrowed money. What does that mean? The more money you borrow, the more digital rents you can take in. And it's like a recursive loop because well, that's if your partners and your lending partners as well, can see this and you can educate them. Then you can have this recursive loop. But that's what we're really focused on this year.
Yeah, I mean, there's one property in specific that we that is coming up on a refi. It's not the one we were working on last year, but this one is a deal that we have with Chase, $7.5 million loan. We just got a term sheet. I mean, overall the rates look good, but the question circulating around the partners is, okay, we're at 50% LTV. Is there any reason for us to take out additional money when they're willing to go up to maybe 60 or 65%? Because why would we can't make, we don't want to put the money in the money market account and make 3%, right? If we're paying 6% on the debt or 5.5%, it makes no sense. So they're all going, okay, well, maybe we just leave it lower leverage, but we're going to be, locked into this deal for a lot longer and cash flow will be better. But, ultimately what I'm going to pitch is I'm going to say, we should take out more money and we should implement Stretch, and do this and basically do the carry trade of what you're saying. I think it makes all the sense in the world if the lender's willing to give you money at 5.5%, and you can take $1 million or $2 million and buy Stretch, why not, right?
So I have like a follow-up question now, because one of the things that we've thought about, or as we've been talking about this, is it a dead end road in the sense of are the banks going to let you, or your lending partners going to let you borrow against that ancillary income stream because it's not rental income, right? It's a different form of income. So I'm wondering, at your properties, do you have any um, secondary income streams? I don't know if you have any like vending machine income at the apartments or something like that, that
Yeah,
you could relate to there.
there's additional lines. There's obviously like parking and storage. There is vending machines, laundry income, uh, all of those other. But I mean, it is included in the underwriting, of course, right? With all lenders, it's obviously the top line, income, the revenue, right? But I don't know. That's a good question. I didn't even think about, them lending also against this secondary line of income through stretch or a product such as stretch, right? Uh, I find it hard to believe that they would. I think it will take time, but I mean, fast forward 5 years from now, if the real estate market is really latched on to all of these, using these different products, buying spot Bitcoin, all of the regulation has passed, and we obviously had more wide scale adoption and understanding. I mean, I don't see why not, right? I mean, it's income for that partnership.
The
Why
argument, I guess, is it doesn't, like, we've heard from some lenders that maybe it shouldn't be included because it's not part of the operations. But we've discussed this on the show a few times where we would argue that it is essential to the operations. It lets us be more selective in development with taking in better tenants. And it also provides a tax shield. So I don't know if you've gone and looked at that and compared it, like, to, depreciation is very important in real estate, right? That's a major reason why people get involved. And when you look at a rock dividend, if you were to, like, rank these, you would rank the rock dividend income higher than depreciation, and how, depreciation is important to operations, and that's, you know um a whole nother topic. But I think that you can make the case that that it will help you with your overall operations by using this tool to operate the property more efficiently and better.
I think there's another angle here too, and I'd be curious to get your thoughts, Boomer. It's like if using your example, if you buy stretch, right, you're able to increase the cash flow. I think you said what, 5 or 7%?
8%, 8%.
8%. Okay. So you get to call up all your LPs and tell them, hey, we have this new strategy. It's going to increase cash flow 8%, right? They're super excited. Do you pass that additional cash flow through to them immediately as part of their distributions, or do you keep them on their existing distribution schedule and maintain that marginal difference in the account and let it grow over the duration of the hold of the asset, right? Of the property. I think there's a couple different things to be said about that. And, to your point, as this kind of gets played out over the next 3, 5, 7 years, I think there'll be some real considerations on how that gets done and who you're raising capital from, because you're going to have people that are making the investments strictly for the cash flow stream, right? Because it's their monthly allowance essentially. And you're going to have growth investors as well. And if you don't match people up with the right vehicle, it's just going to be a headache for everybody involved. But that aside, I think the financial performance standpoint, I mean, looking at it through that angle is probably the starting point, because again, you're in these assets, these investments for 5 to 10 years. I mean, that's some significant time to let these things compound, let them do what they're designed to do, and again, distribute the additional returns to the LPs at different intervals, right? If it's a 10-year hold, maybe you have a big distribution at year 3, 6, and 9, or something. I mean, you could get really creative. And I guess where I'm going with this is, have you thought about that? And if so, what are some of the impediments of making that happen today? Is it strictly the educational piece, or are there things in the operating agreement that limit or tie your hands on what you cannot do with the funds as a fiduciary?
Yeah, I mean, I think it's always cleaner to do it up front. When you set up the partnership or you raise the money. But I don't think it's out of the realm of possibility. I think for most of our agreements, it's just a simple, hey, here's what it is. Do you guys, want to take this venture or not? Everybody vote, and we either move forward or we don't. So I think that's from that standpoint. I don't think it's necessarily too complicated. You just got to get, partners' say on it first, which is, again, what we've been talking about, trying to work on them, at least getting maybe some of the, what I would call more seasoned or larger scale, partners on board first, right? And then I think it starts to kind of waterfall down. And as you mentioned, it's not that, the numbers will speak for themselves, right? We don't really, all we need to do is we need to present, like you said, present a solution to maybe an issue that they're having. Obviously, the real estate market in general, as of late, returns are, getting compressed. It's harder to find deals or good deals. And so when you can differentiate yourself again from the market and inside your partnerships to end up, again, we would pass a lot of this cash flow through unless there was a strategy where it wouldn't make sense, right? And we say, okay, this is a heavy lift. We're going to buy this property. And maybe what we do is we use those to pay for, we're not going to raise additional money for the CapEx or a capital call. What we're going to do is we're going to use the funds that come from this for the first 24 months. Once we're done with that, then we're going to start a distribution schedule, quarterly payouts, even though it is paid out monthly. So again, I think there's a lot of flexibility. We aren't set on it. We're looking at all options. So, I think it's just a trial and error. And again, it comes down to the partnership level, I think, on what they're most comfortable with.
Yeah, that's very much consistent with, what I've heard, talking with, other folks is situational cases and, understand it, the education piece. But I like your point, as far as going to the biggest investors, getting their buy-in first.
Yep.
And then it just letting it, trickle down from there. That's a good way to do it for sure.
Yeah, and that first approach, right, was the offensive approach, which we talked about is kind of the treasury, build the treasury, and or acquisition, kind of capital raising. I kind of break it into three parts on that side. And we were under contract on a deal in Oregon at the end of the year, and I put together the metrics that we typically look at: cash on cash return, equity multiple, IRR, and then total profit after 10 years. We underwrite our deals all on a 10-year basis. And so when I was able to break that down, I actually showed them those level of metrics, and it was interesting when I look at it side by side. What it showed was the cash on cash ended up actually dropping about 40 basis points. So we went from like a 7% cash on cash return, or sorry, 7.4 cash on cash return in a standard capital raising deal with no Bitcoin infusion at allocation up front. And then when we went to the integration of Bitcoin into the capital raising side, it actually dropped down to 7%, but with the IRR, it actually jumped up 280 basis points. So it got us almost to a 20%, IRR on that over the life of the hold. The equity multiple increased by 93 bips, so almost 100 basis points on the equity multiple by putting a small 5% allocation up front. So,
and that was just Bitcoin, yeah.
And that was buying spot Bitcoin up front. So that was raising the capital at 100% on both deals. Actually, it was 105%. So it was raising 5% additional money on the Bitcoin infused capital side, right? Just so that we thought it was cleaner from, maybe the lending execution, because the lender might get a little hairy if you're trying to say, okay, we're going to raise 95%, in USD and then 5% in Bitcoin, right? So what we said is we're going to go to the partners, we're going to raise 100% in both deals. In the Bitcoin infused, we're actually going to raise 105%, but it's going to juice your returns on the back end. It actually would net dollar figure wise, I think it was a little over $3 million on the back end. So your IRR increased by 280 basis points. Your cash on cash immediately dropped because obviously you're raising a little bit more money on the front end.
Mm-hmm.
But your equity multiple increased by like I said, 93 bips, and you basically came up with another $3 million at the end to pay off. So whether you use that to pay down the loan, right, or do a special distribution or whatever you might do, it works on all the different metrics. So they were able to kind of see the numbers and latch onto that, which again I think was really helpful. So showing them our acquisition model and then walking them through this and saying, here are these deals side by side. And for a small amount of risk, you're going to have a massive outsized return. So there was just a lot of asymmetry, right? As we always talk about with that. So 5% allocation increases all of those different metrics.
And I love the fact that it's just, it was just 5%. Right. I mean, that is in the grand scheme of the project or the investment you're talking about, that is a negligible amount. Right.
Totally.
And the returns are, to your point there, it's an asymmetric opportunity. So you don't have to go and be a Bitcoin expert. You don't have to sell the farm. You don't have to bet the farm. A small sliver is going to do the job.
Well, and as much as I like that position, obviously our goal is to accumulate more Bitcoin, right? So it's like when you go with an allocation, at the end of 10 years, if you look at it, you got the same amount of Bitcoin on the balance sheet as you did 10 years ago. I think you ultimately did it wrong. So it needs to be a little bit of a combination of a couple of different things, right? But I'm just, again, what we're doing is we're trying to throw these things out to the investors in different ways and see what ultimately sticks, what works, what's maybe easiest from, again, compliance standpoint, legal, where maybe that product fit works, for at least our investors, right? And maybe that's the broader scale, investment market as well. But again, we're trying to at least put these strategies forward and see what type of feedback we get.
On that particular deal, Boomer, curious to know, did you get like a lender on board with that one, putting the extra 5% in Bitcoin to use for the use of funds?
So it would be the way that we were going to structure it. It would be an additional. It would basically be a sidecar, like an additional LLC that was inside the partnership. So we talked with our accountants about it. They figured out how that would be the cleanest. So where we necessarily didn't have to get the lender involved, and that's why we chose.
Okay,
Does that make
interesting.
sense?
Yeah, no, I totally understand
So
that. So,
yeah, it's like when you look at it, right? You still want to have in the partnership, you basically have the umbrella, and then you have the real estate and then the Bitcoin, right? And two separate entities, but both of them, when you're reporting, are going to be in that one overarching, entity, if that makes sense.
that's interesting that you structured it like that. That's cool.
Yeah, we were going back and forth on that for a while, and it ended up being the cleanest way that we found. But again, we're open to a different structure as well. If the lender is more open to it, then yes, we would definitely want to structure it maybe a little differently.
Yeah, the creativity, the number of options is incredible when you start to really drill down into it.
When you start playing around, and I know that this particular scenario, you're just doing spot Bitcoin, but when you add, we've been playing around with potentially doing some private credit offerings, and when you create a basket of these digital credit instruments. You put spot Bitcoin in there, you put stretch in there. You can actually see the cash on cash return go up instead of going down, and it just gets even better. So I think it's going to be it's great to know that there's other operators out there looking at this because it will become banks and lenders won't be able to ignore this if there are smart operators that are seizing the moment. They're going to lose business. So they'll find other ways to fund the deal, whether it's private credit or other instruments. And I think that's the good news is that there's more than one way to fund these projects.
Yeah, no, and we are talking with, I think you guys are as well, Andrew Hones, with Battery Finance. So we've been exploring, a couple of upcoming refinances with them. They're working on different structures. So yeah, I mean, again, I think all of us are, uh, kind of tinkering around with, different avenues. But ultimately, I do think everybody will ultimately conform, will put this stuff into practice, and everybody will do it differently, which I think is actually quite nice. But yeah, I mean, I do think that it's gonna change real estate. It's gonna change returns. It's gonna change, the expectations for these deals. So I think we've got a lot in store for the real estate community for sure.
Awesome. Well, Boomer, thanks for joining us today. For Boomer Beatty, Chris Drizga, and Kenny Alves, I'm Tim Kotzman. That's it for today's episode. If this conversation was useful, please share it with a partner, a client, or somebody making real decisions in the marketplace. New episodes drop weekly, so follow us on our channel. Until next time, stay disciplined, think long-term, and stack sats. This is the Real Estate Standard.
Sweet.